What's the worst investment I ever made? Hey guys, it's Adrian here, the Canadian in a t-shirt. And today I'm breaking down my all-time worst performing stock. I wish I never bought it. This is a brand new series where I'll compare my biggest winners with my biggest losers and share the lessons I learned. I've been investing for over a decade, and I'm proud to say most of my stocks have been profitable. I've had a few home runs like Nvidia. I'm up almost 900%. I'll cover that in the next video. But no matter who you are, you're gonna have some losers. That's part of the game. So before I brag about my biggest wins, let's be humble and start with my biggest loss. And that's Allied Properties, ticker symbol AP.UN. The last time I covered Allied Properties was over 6 years ago, back in April 2020. I can't believe 6 years have passed. But if you remember, that was 1 month into the COVID lockdowns. As you can imagine, the lockdown was devastating for a real estate company that focuses on office properties. That's why I made that video. I covered 4 stocks that were hit hard from the COVID crash. 4 companies that I invested in. I bought in at the dip. I expected them to recover and earn a nice profit. Now, when it comes to Allied Properties, boy was I wrong. Since that video 6 years ago, I'm down 75%. Ouch. Now, I also collect dividends every month, which dampens the blow. But overall, looking here on Blossom, you can see I'm still down over 52%. That sucks, but it could be worse. In the end, I've only lost about $1,000 from this stock. I take it as an expensive lesson. So I was definitely wrong about Allied Properties, but in my defense, looking at that old video from 2020, I was right about the other 3 stocks. My biggest rebound play was BMO, and that was definitely the right call. My BMO stock is up over 125%, plus an extra 30% in dividends. So I've made over $3,000 in profits from BMO alone. A big part of that came from buying the dip. Number 2 was Fortis. I'm up 45% in capital gains, plus 21% in dividends, for a total return of 66%. Not bad for a boring utility. Number 3 was TELUS, which has been rough the past 3 years. From the share price, I'm down 25% right now, but the dividends make up for it at 31%. So overall, I have a net profit of 6%. I wouldn't call that a win, but I'm still holding, hoping it recovers. I'm not a genius stock picker or anything like that. My point is just that you have to accept risk. You're gonna have some losses. It sucks seeing my Allied stock down 75%. But as long as you diversify and focus on the long term, my gains far outweigh my losses. Again, looking at my Allied stock, I put in about $1,800 and I'm down 75%. Meaning that if I sold everything today, it would only be worth $445. Ouch. So, what went wrong? First of all, Allied Properties is a REIT, a real estate investment trust. Basically, it owns hundreds of real estate properties and rents them out. And every month, it pays a majority of that rental income out to us, the investors, through dividends or distributions. Watch my REITs explain video for all the details. Now, most of the REITs I own are retail REITs, meaning their properties are shopping malls and grocery stores. All of my retail REITs have recovered since the COVID lockdowns, and they're all in the green, while still paying high dividends every month. Allied is different. They don't own retail properties, they own office properties. And that's why they're losing money. How many of you guys are still working in the office every day, even 6 years later? That's the problem. Let's wind back the clocks 6 years ago, before the pandemic. Very few people work from home. Most of us came into the office every single day. That was the status quo for the past century. Because of that, office properties owned by Allied were in high demand. In fact, they had an occupancy rate above 95%. Amazing. And those weren't cheap properties. No, their focus was pristine urban workspaces, especially targeting the tech hubs in Toronto, Montreal, and Waterloo, where I worked. Most of their tenants were the cutting-edge, fast-growing tech companies in Canada. I saw it firsthand. Working in tech, a big part of the appeal was the cool mixed-use office space. Think of the industrial turned modern look with high factory ceilings, breakout rooms with exposed brick and metal pipes, multimedia rooms, games rooms. Those were not boring cubicle offices. And they definitely weren't cheap. But booming tech companies would pay top dollar for this cool office experience. And that worked for many years. As the demand grew, the rents would increase accordingly. That was the thesis behind Allied Properties, and I was there firsthand. I was definitely biased. I worked in an Allied building for many years, back when I was an AI engineer. Our building was a massive old factory in Waterloo, converted into a tech hub. And then across the street, they built a massive, epic office for Google, again owned by Allied Properties. I saw the growth of the Waterloo tech sector over the decade. It was exciting, and there were no signs of slowing down. And Allied, they owned most of those buildings. That investment was a no-brainer. And then COVID happened, and everything came to a screeching halt. We were all working from home, but all the companies were still paying their office rent. Those leases were still locked in. Everyone expected to return to the office in a matter of months. I don't think anyone expected that we'd still be working from home 6 years later. Now, working from home or a hybrid model is the new norm. Even though companies are ramping up on return to office mandates, the reality is that office space demand has plummeted. We used to need huge office spaces, able to house every single employee every day, plus extra desks, extra meeting rooms. Now, people don't even have a dedicated office desk anymore. The demand isn't there. Allied still owns those buildings. They still have to pay huge mortgage payments, but there's no one to rent them out to. In 2020, Allied had occupancy rates over 95%. Now, it's below 85%. In Waterloo specifically, where I saw the boom firsthand, their occupancy has dropped to 75%. It's very sad. Low occupancy means less revenue, and rising interest rates, especially since 2022, means huge expenses. They're not profitable. In fact, they're about $5 billion in debt. So much so that they had to start selling major real estate properties. But that's a band-aid solution. Selling off properties is a one-time cash influx. They're supposed to be growing and collecting monthly rent. Speaking of band-aids, 2 months ago, they announced $500 million of asset and equity sales to pay down their debt. It seems prudent, but it's not very encouraging. Selling equity and assets is a band-aid, but the low occupancy, that's the gushing wound. They need tenants. Their last hope is for a full return to office across the country, to go back to the way things were. Sadly, that's out of their control. The world has changed, and I don't think it's going back. What is in their control is their dividend. And that's another piece of news. Back in 2020, when I invested, they paid a monthly dividend with a reasonable yield of 3.7%. Nothing crazy, but solid and reliable. It had a low payout ratio and FFO ratio. That tells us the dividend was sustainable. When it comes to REITs, we don't use regular earnings. Instead, we use FFO, funds from operation. It's more representative of their true cash flow. So back then, we could count on those monthly dividends. In fact, they had been increasing their dividends every year for a decade. That's great, until it fell off a cliff. Since 2020, the share price continued to fall, so the dividend yield grew and grew. It started at a reasonable 3.7%, but by the end of 2025, it had grown above 10%. I always tell you guys, any dividend above 6 or 7% is a red flag. Yes, it's enticing to investors, but it's just not sustainable. And it's only a matter of time before it gets cut. That's exactly what happened in December 2025 when they slashed the dividend by 60%. That's huge. Until a few months ago, each share of Allied paid a dividend of 15 cents a month. Then in December, it was cut down to only 6 cents a month. With a stock like this, there's no growth. The only thing it had going for it was the monthly dividend income. But I say time and time again, do not chase dividend yields. You don't want a high dividend that gets cut by 60%, then you're left with nothing. Instead, go for sustainable and growing dividends. Now, to their credit, Allied was able to maintain their dividend even during the worst times of the pandemic. Despite lockdowns, low occupancy, rising interest costs, and falling revenue, they held their monthly dividend fixed at 15 cents per share for the past 3 years. In fact, they increased their dividend in 2023, 2022, and 2021, even after the pandemic, just to maintain their dividend growth streak. I get why they did it. You don't want to scare away dividend investors, but in hindsight, this dividend cut was inevitable, and they should have done it sooner. So, where are we today? Well, the dividend has been cut by 60%, down to only 6 cents per share. And even so, it still has a scary high dividend yield over 7%. And that dividend is the only thing enticing investors today. Looking at the share price over the past 5 years, it's basically been a straight line down. In fact, if we zoom out to all time, since the company went public in 2003, we are back where we started out. 23 years later, and there's zero growth. The share price is back at $10 a share. It's painful to see. The only thing going for it is that high dividend of 7%. But is that sustainable? Well, before the 60% dividend cut in December, they had an FFO ratio above 90%, certainly on the high side. Now, after the cut, according to their Q1 earnings, their FFO ratio has dropped to about 70%. More reasonable. I don't expect another dividend cut this year, but unless they can cut down their debt and boost revenue and occupancy, I'm very worried. So, 6 years later, should I have known better? Honestly, I'm going to give myself a pass on this one. In 2020, nobody expected that working from home would be the new norm, especially in booming sectors like tech, UI, UX, and design. The best part of those jobs was the camaraderie and the bonds formed by struggling and experimenting and building something together every day in person. That was the best part of my career, and I'm sad that we lost it. Back then, we needed office spaces to work, but the lockdowns, it proved that we don't. We can get the job done working from home. So companies cut costs. They either shared a smaller workspace or no office at all. I know that I'm biased, but I believe that if COVID never happened, Allied Properties would be doing well. So the key lesson is this: anything can change. Even things that were previously unthinkable, they can happen, and with no warning. The only way to protect yourself is to diversify. Never put all your eggs in one basket. And thankfully, I did diversify. Yes, Allied stock is my biggest loser. I'm down 75%. But because I diversified my portfolio and spread my money, I only lost less than $1,000. So I survived, and my winners far outweigh my losers. Am I going to sell my stock? I don't think so. Until I actually sell those shares, that 75% loss is just on paper. Plus, I'd only get $450 anyway. At this point, I'm just gonna hold and hope it recovers. And in the meantime, I continue to earn those dividends every month and cross my fingers that they don't cut them again. I regret buying this stock. Back in 2020, I could have avoided this mistake if I had research tools I do now thanks to MOOMOO, one of my favorite brokerages in Canada. With MOOMOO, I get a comprehensive breakdown of any stock, their financials, their dividend history, and their dividend sustainability. And all of these research tools are free. I especially love them for my US stocks because of their super low currency conversion fees. Check out my past videos where I highlight the research tools of MOOMOO and use my referral link down below to get a sign-up bonus worth up to $600. You guys know me, I'm not a trader. I'm a long-term investor. But when it comes to a losing stock like this, I wish I had cut my losses and sold years ago. If you are interested in active trading, right now for the month of June, MOOMOO, along with NASDAQ, is hosting a contest, Canada's Top Trader. They're giving away $1 million worth of prizes. Plus, you can get your face on the NASDAQ billboard in Times Square. Contest details and sign-up link down below. So that is my worst stock of all time. Next episode in the series, I'll cover my best stock. Stay tuned. Thanks everyone, and I'll see you guys on the next episode of The Canadian in a T-Shirt. Bye guys.